Dollar crashes 9% in 2025. Billionaires flee. Why? From 2010 to 2024, the dollar didn't just rise. It soared. 40%. The longest bull run in modern history. But here's the thing, bull runs don't last forever. In 2025, the music stopped. 9% drop in 12 months. Morgan Stanley called it the end of the cycle. But why now? First, global reserves. The dollar's share fell to 56.3% in 2025. The lowest since 1995. Second, tariffs. High. Volatile. Third, Fed versus Trump. The Fed cut rates. The dollar weakened. Inflation. Rising. This isn't just a chart. It's a shift. This isn't just paper. It's a promise, and that promise is breaking. But here's the question no one's asking: how is this affecting your wallet? We'll get to that. You asked how this affects global markets and your wallet. The answer: like a row of dominoes. One push, and everything changes. First domino, American exporters. Boeing just booked its biggest order in a decade. Why? A weaker dollar makes their planes cheaper overseas. Apple. Same story. Their iPhones now cost 12% less in Europe. But here's the twist: what's good for them is brutal for you. That same dollar buys 9% less today. Electronics. Up 14%. Oil. A barrel now costs $95, even though global supply is steady. Therefore, your paycheck doesn't stretch as far. But the dominoes keep falling. Emerging markets, India, Brazil, Vietnam, they're breathing easier. Their dollar-denominated debt just got 9% cheaper to service. Yet here's the catch: capital is fleeing. Investors are dumping local currencies for something safer. What's safer? Gold. It's up 22% this year. Commodities too: copper, wheat, silver. They're the new dollar. And then there's crypto. Bitcoin just hit $82,000. Why? Because when currencies collapse, people don't trust governments, they trust math. But here's where things get dark. Microhook: not everyone wins in this new world. The question is, are you on the right side? Open loop: who are the winners and losers in this new world? The answer will surprise you. You asked who the winners and losers are in this new world. The answer: the ultra-wealthy aren't waiting to find out. In 2025, Ray Dalio moved 15% of Bridgewater's portfolio into gold. Not a hedge. A statement. But Dalio wasn't alone. Warren Buffett increased Berkshire's stake in Japanese trading firms overnight. Why? Because the yen was cheap, and the world was getting expensive. Then came Elon. Tesla's cash reserves. Diversified into Bitcoin and commodities. The message was clear: the dollar's reign isn't guaranteed. Family offices followed. Private credit. Real assets. Tangible things. And U.S. Treasuries. They're selling. Lydon whispers, they're not just diversifying. They're preparing for a reset. So here's the question: what's the one asset class they're all betting on? Stay with me. The answer changes everything. You're watching the dominoes fall. But here's the thing: no one told you who pushed the first one. The Federal Reserve. 3 cuts in 2025. 3 signals to the world: the dollar isn't what it used to be. And now, the question you need to ask: what happens when the world's reserve currency starts to wobble? Let's start with the numbers. In the first half of 2025, the dollar index fell 11%. 11%. That's the worst drop since 1973. For context, 1973 was the year Nixon shocked the world. The year the US abandoned the gold standard. The year the dollar's value was set free, and promptly crashed. Now, in 2025, we're seeing the same pattern. But this time, it's not gold. It's something far more dangerous. Here's how it works. When the Fed cuts rates, it's like lowering the interest on a savings account. Foreign investors look at US Treasuries and think, why park my money here when I can get better returns elsewhere? In 2025 alone, foreign holdings of US debt dropped by $472 billion. That's the biggest outflow since the 2008 financial crisis. And when demand for the dollar drops, its value drops with it. But here's where it gets worse. This is now worth 9% less than it was 6 months ago. Think about that. Every dollar in your wallet, your bank account, your retirement fund, shrinking. And what do people do when their money loses value? They spend it. Fast. That's how you get inflation. The Fed cuts rates to stimulate the economy, but all it does is devalue the currency and push prices higher. Now, let's talk about the Fed's balance sheet. It's still bloated. $7.2 trillion in assets. That's down from its peak, but it's still more than triple what it was before 2008. And here's the kicker: every dollar the Fed prints to buy those assets is another dollar diluting the value of the ones already in circulation. It's like adding water to whiskey. The more you add, the weaker it gets. So why did the Fed cut rates in the first place? They were trying to save the economy. Growth was slowing. Unemployment was ticking up. The stock market was volatile. The Fed's playbook says, cut rates, stimulate borrowing, boost spending. But in 2025, that playbook backfired. Because this isn't 2008. It's not even 2020. The rules have changed. Here's the part no one's talking about. The dollar's decline isn't just about the federal. It's about the alternatives. China's yuan is gaining ground. The euro is stabilizing. And gold? Gold is up 22% in 2025. The ultra-wealthy aren't just moving money out of the dollar. They're moving it into assets that don't rely on the Fed's whims. Remember that 15% portfolio shift? That's not a bet. It's a lifeboat. But here's the open loop you need to hold on to. What's the historical precedent for this? Because if history is any guide, the dollar's decline isn't linear. It's a cliff. And the fall? It's already begun. You remember the question from the last segment, don't you? What's the historical precedent for this? Well, history doesn't repeat, but it rhymes. And in 2025, the dollar's crown started to slip, not with a bang, but with a whisper. A whisper heard in boardrooms, farmhouses, and retirement communities around the world. Let me tell you about the day the dollar lost its grip. Not in theory. Not in headlines. But in the lives of real people. Take John Carter. He runs a mid-sized factory in Ohio. In 2024, his export orders were flat. Then, in early 2025, something changed. The dollar weakened. Suddenly, his machines, made in America, were 20% cheaper for buyers in Europe and Asia. Orders surged. His workforce grew. His phone wouldn't stop ringing. But here's the thing, John didn't change a single thing about his business. The shift wasn't about him. It was about the dollar. And that's when he realized, the rules had changed. Now, let's cross the Atlantic. In Milan, a family-owned leather goods company had a problem. Their handbags, once priced at $2,500 in the US, now cost $2,875 after the dollar weakened. Sales in New York dropped 15%. Tourists stopped buying. The CEO told me, "We didn't raise prices. The dollar did." And just like that, a century-old brand was fighting for survival. But the ripple effects didn't stop there. Meet Rafael. He's a farmer in Mato Grosso, Brazil. In 2023, he took out a loan in dollars to buy new equipment. Why? Because dollar loans were cheaper. But in 2025, the real strengthened. The dollar weakened. Rafael's debt, in local currency terms, shrank. He paid it off early. Saved millions. His family celebrated. But here's the dark twist, Rafael's story isn't universal. For every farmer who won, there was a borrower in Argentina or Turkey who lost. Because when the dollar weakens, someone always pays. Now, let's talk about Maria. She's a retiree in Tampa. Her pension is fixed. Her savings? Mostly in dollars. In 2025, her grocery bill jumped 8%. Why? Because the food she buys, coffee, olive oil, chocolate, is imported. And when the dollar weakens, imports get more expensive. Maria told me, "I didn't ask for this. I just wanted to retire." Her story is the one no one talks about. The quiet suffering of millions who never saw it coming. And then there's the Chinese tech firm. They were sourcing components from the US. But in 2025, tariffs and a weaker dollar made it too expensive. So they shifted their supply chain to Vietnam. Overnight, thousands of jobs moved. Not because of politics. Not because of war. But because of the dollar. And that's when the geopolitical dominoes started to fall. Now, here's where things get interesting. These aren't isolated stories. They're symptoms. Symptoms of a system in flux. The dollar's dominance isn't gone, far from it. But in 2025, the world started to hedge. Central banks diversified. Companies rerouted supply chains. Retirees like Maria tightened their belts. And that's the thing about empires, they don't collapse overnight. They erode. One trade. One loan. One grocery bill at a time. But here's the question no one's asking, what happens when the erosion accelerates? Because the dollar's weakening isn't just an economic story. It's a human one. And the next chapter, it's already being written. Stay with me. Because what comes next will change how you see the world. You asked for the global fallout. Here it is. The dollar's decline isn't just a US problem, it's a global earthquake. And the aftershocks? They're rewriting the rules of power. Point number 1, China. In 2025, the yuan became the world's second most used reserve currency. Not the euro. Not the yen. The yuan. Why? Because 42% of global trade is now settled in yuan. That's up from 12% in 2022. But here's the kicker, China didn't just wait for the dollar to fall. They pushed it. In 2024 alone, China dumped $347 billion in US debt. Therefore, the dollar's share of global reserves down to 47%. The lowest since 1995. Now, let's talk about Europe. A weaker dollar means a stronger euro. And for German exporters, that's a windfall. BMW, Mercedes, Siemens, all saw profits jump 18% in 2025. But here's the twist, Europe's gain is America's pain. Point number 2, OPEC. Oil is priced in dollars. So when the dollar weakens, oil producers get paid more. In 2025, OPEC's revenues hit $1.2 trillion. That's a 31% increase in 2 years. And they're not just sitting on it. They're diversifying. But wait, it gets worse for the US. The dollar's decline isn't just about money. It's about power. For decades, the US enjoyed what French Finance Minister Valéry Giscard d'Estaing called the exorbitant privilege, the ability to print the world's reserve currency. But in 2026, that privilege is under attack. The US now owes $34 trillion. And with the dollar weakening, foreign investors are asking, why hold dollars when we can hold yuan? Point number 3, emerging markets. For countries drowning in dollar-denominated debt, a weaker dollar is a lifeline. Argentina, Turkey, Nigeria, all saw their debt burdens shrink by 15 to 20%. But here's the catch, capital flight. As the dollar weakens, investors flee to safer assets. Therefore, the winners, the countries that can attract capital. The losers, the ones left behind. Now, here's the part no one's talking about. This isn't just about economics. It's about geopolitics. A weaker dollar means a weaker US. And a weaker US means a more multipolar world. China, Russia, India, they're not just waiting for the dollar to collapse. They're building the infrastructure to replace it. But here's the question I need you to sit with. What's the biggest misconception about the dollar's decline? That it's a slow, gradual process. It's not. It's a cliff. And in 2026, we're standing at the edge. You thought the dollar's decline was just about numbers on a screen? Think again. This is war. A war of ideologies. A war for your wallet. And the biggest misconception? That there's even a debate. Proponents scream from the rooftops, a weaker dollar means American goods flood global markets. Exports surge. Jobs return. The trade deficit vanishes. Sounds perfect, right? But here's the catch, it's not that simple. Critics fire back with a single word, inflation. Your dollar buys less. Gas prices spike. Groceries cost more. And who pays the price? You. The American worker. The saver. The retiree. But wait, there's a third camp. The realists. They don't see strength or weakness. They see correction. After decades of dominance, the dollar was overvalued. Now, it's finding balance. Therefore, the question isn't if the decline is good or bad. It's whether the Fed can thread the needle. And then there's the politics. One side calls it economic sabotage. The other, a necessary reset. But here's what no one's saying, this isn't about left or right. It's about survival. The dollar's decline isn't a bug, it's a feature. A feature of a system that's been broken for years. Therefore, the real debate isn't about the dollar at all. It's about who controls the levers. The Fed? The markets? Or the people who refuse to play by the old rules? This isn't about politics. It's about survival. And the strategy that works in any scenario? That's coming. But first, you need to see the one thing no one's talking about. You asked for the one strategy that works in any scenario. Here it is, not one strategy, but three. 3 moves the ultra-wealthy have used for centuries to outlast empires, depressions, and currency collapses. But here's the catch, most people never implement them. Therefore, today, you'll walk away with the exact blueprint. Strategy number 1, allocate 10 to 20% of your portfolio to gold and commodities. Not because it's shiny, but because it's survival. In 2022, gold outperformed the S&P 500 by 17%. In 2023, it hit all-time highs. And in 2026, the trend isn't reversing. But here's what they don't tell you, gold isn't just a hedge. It's a statement. A statement that says, I don't trust paper. Therefore, if you're not holding gold, you're betting against history. And history always wins. Strategy number 2, diversify into emerging market ETFs. India, Vietnam, Indonesia. These aren't just countries, they're engines. In 2025, India's GDP growth outpaced the US by 3.2%. Vietnam's stock market returned 28% in a single year. But here's the kicker, most Western investors are still asleep. They're stuck in the 20th century, betting on the same old names. Therefore, the smart money is moving east. And if you're not part of that movement, you're missing the greatest wealth transfer of our time. Wait, it gets better. Strategy number 3, digital assets as a hedge. Bitcoin, Ethereum. Not as speculation, but as insurance. In 2024, Bitcoin's correlation with gold hit 0.87, meaning it moved almost identically to the one asset that survived every financial crisis. But here's the twist, while gold is stable, Bitcoin is volatile. Therefore, you don't need to go all in. Just 1 to 5% of your portfolio. Enough to protect you if the system breaks. Enough to profit if it doesn't. Now, let's talk about what you shouldn't do. Strategy number 4, reduce exposure to US Treasuries and dollar-denominated bonds. Why? Because in 2025, the US debt-to-GDP ratio hit 125%. That's higher than Greece during its crisis. And the Fed? They're printing money like it's going out of style. Therefore, bonds aren't safe. They're a trap. But here's where things get interesting. Strategy number 5, real assets. Real estate. Infrastructure. Things you can touch, things that generate cash flow. In 2026, inflation isn't going away. Therefore, the only assets that keep up are the ones tied to real value. Not stocks. Not bonds. Bricks. Steel. Land. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. But here's the question no one's asking, what's the one critical insight you need for 2026? The answer isn't in the markets. It's in the mindset. And that's what we're covering next. You asked for one critical insight for 2026. Here it is. The dollar's decline isn't an accident. It's a signal. A signal that the world is changing, faster than most people realize. And if you don't understand this shift, you'll be left behind. The Fed's actions in 2025 didn't just weaken the dollar. They accelerated a trend that's been building for decades. The US isn't just printing money anymore. It's printing a new economic reality. One where the dollar isn't the only game in town. But here's what no one's telling you. Billionaires, Musk, Buffett, Dalio, they're not waiting to see what happens. They're preparing. Why? Because they know this isn't just about the dollar. It's about the next decade. A decade where the battle for reserve currency status will reshape the global economy. And your portfolio? It's either adapting or dying. The ultra-wealthy have 3 moves they've used for centuries to outlast empires. But most people, they'll never implement them. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now, the question isn't whether the dollar will decline. It's whether you'll be ready when it does. The reset has begun. Are you ready? Lydon looks directly into camera. Pause, because here's the one move you must make now. You've been waiting for this. The one move. The secret the ultra-wealthy don't just use, they guard. Here it is, 30%. That's the number. 30% of your portfolio must be in non-dollar assets by 2026. Not next decade. Now. Why 30%? Because the ultra-wealthy aren't just diversifying, they're building currency-agnostic portfolios. Assets that thrive whether the dollar rises, falls, or collapses. First, the foundation, gold and commodities. These aren't relics, they're insurance. When currencies devalue, gold doesn't just hold value, it appreciates. But here's where it gets surgical. Digital assets, Bitcoin, Ethereum, aren't just tech plays. They're currency hedges. A hedge against the very system that's printing trillions. The ultra-wealthy don't bet on crypto. They bet against the dollar. And growth? Emerging markets. While the West stagnates, these economies are accelerating. The ultra-wealthy don't chase trends, they anticipate them. Real assets. Infrastructure. Real estate. Assets that produce value, not just paper promises. This is how empires are built, and how they survive. So here's your move, 30% non-dollar. Gold. Commodities. Digital assets. Emerging markets. Real assets. Not because it's trendy, because it's survival. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now you know the secret. Use it. You just saw the number, 30%. But that's only the first piece. The next crisis isn't coming. It's already here. And if you're not prepared, you'll be the one holding the bag. Here's your move, subscribe now. I'm giving you the 2026 Wealth Playbook, 5 assets to buy before the reset. No fluff. No hype. Just the exact strategy the ultra-wealthy are using right now. Next video, the silent killer of your retirement savings in 2026. This isn't fear-mongering. It's math. And if you miss it, you'll regret it. Hit the bell. Stay ahead of the reset. Your financial freedom starts now. Don't miss this. What's the next threat to your wealth? You'll find out in the next video.